With that, let's have a deep look at the oil and gas sector. We have Mr. Dayanand Mittal joining us, who's the oil and gas as well as the Telecom Research Analyst at JM Financial Institutional Securities. Thank you for joining us on the show. Well, my first question to you will be around the latest development of this sector, largely around the lower allocation to the domestic gas to the CGD space. Can you give us some more idea about how do you see your view on the gas companies in this space?
Yeah, good afternoon. Thanks for having me. Obviously this sharp cut in APM gas allocation for CGD sector by another 20% after last month's 20% cut. This is a significant negative development for all CGD companies, particularly CNG dominated companies like IGL and MGL, because this raises their average gas cost by about $1 to $1.50 depending on how this source this deficit via mix of new well gas, which might come at around $9, or via HPHT gas, which might come at closer to $10, or from imported LNG sources, which might cost around $10 to $14. So $6.50 gas gets replaced by alternative sources which might cost anywhere between $9 to $14. So weighted average gas cost goes up by about $1 to $1.50, which means they might need to take a CNG price hike of closer to 6 to 10 rupees per kg versus the current CNG price, which is around 75 rupee for IGL and MGL in Delhi, Mumbai. So about 8 to 13% hike. Do they have the pricing power to take this? Definitely they can, just that the differential versus petrol, which has already moderated over last few years, from highs of 60-65%, CNG used to be 60-65% cheaper versus petrol on a rupee per kilometer basis 3 years back. That has come down to more like 40-45% currently, and after this two successive APM allocation cut, that might come down to more like closer to 35%. Which is decent but not great. So conversions may moderate further is what our thought is. And versus diesel, this gap will narrow from closer to 20% to more like 15%, which would be probably at the lower end of what most of the CV users need to incentivize them to convert to CNG. So there would be some hit to margins, given CGD companies may or may not pass this on entirely to the consumers, given their focus on volume, and definitely this would also lead to some moderation in CNG conversion and hence on growth. So definitely a big setback for the CGD companies, but there's some hope. It's a hope as of now, but yeah, that government may announce some offsetting measures in terms of either reducing the excise duty on CNG from current 14.5%, or maybe if they can convince the states to get gas under GST, though that might be slightly a long drawn process. Yeah, so we have currently downgraded both the stocks to sell because of this negative development.
Got it, Mr. Mittal. But you speak of a scenario, first of all, natural gas getting into under the GST regime. That's a longer process. In terms of excise duty cuts, do you think that's more likely, or the CNG price hike is more likely? Because we do have ongoing state elections, and this also comes in a time where people are also expecting petrol and diesel price cuts. So how does all of that play out in terms of price hikes or cuts in certain aspects of pricing?
So what I understand, and all these companies during the recent con call also suggested that they are in discussion with ministry, because this is a significant detrimental step and would reduce incentive for these companies. Particularly, there are many new CGD companies which have taken license in last few years, so their investment plans might get jeopardized. And hence they are discussing with government to see how this negative impact can be offset. So probably government might take this call shortly, next probably hopefully few weeks. And if this excise duty cut comes in, then maybe there may not be a requirement for a CNG price hike. But if this doesn't come through, then the CGD companies might be forced to take price hike. They might decide, instead of taking a one-time 8 to 10% huge hike, they might try to phase it out over next few months. That's a possibility. So there could be some near-term impact on earnings. but largely I think they should be able to pass it on. But yeah, would have long-term negative consequences of that in terms of lower margin and volume growth profile.
Got it, Mr. Mittal. Let's shift to the, oil, upstream and downstream segment. First of all, what are your expectations on oil prices moving forward? Do you expect them to have a downward bias? Because while OPEC does have some strength, China demand continues to falter. And in the light of this, what's the outlook on the upstream companies, which especially ONGC, who's seen production declining for almost 6 years now?
Yeah, so our thought is that OPEC Plus still has got a reasonably strong pricing power, primarily because US crude production is not rising as fast as it used to do pre-COVID. It used to grow by 1 million barrel per day on an annual basis pre-COVID. Now it grows by 0.3, 0.4 million barrel per day. So it's not as strong. Plus, during COVID, we saw how sharply OPEC cut output by 10 million barrel per day to offset the huge demand setback. So they have that ability to cut output further. They've currently cut output by about 5.8 million barrels per day versus 10 million that they had cut during COVID. So given the strong pricing power, do we agree the Chinese demand concern is a genuine concern from a medium to long term? But next 2-3 years, we believe OPEC Plus, because of the strong pricing power, can support crude around at $75-80 per barrel, which is Saudi's fiscal break-even. But from a 5 to 10 year view, we think because of the potential impact of EVs and alternate fuels like LNG on oil demand, oil will gradually head closer to the marginal cost of production, which is closer to $60. So given the near-term positive view on crude, we have a positive view on ONGC and Oil India. The stocks have corrected in the last 1 or 2 months by about 15-20% plus. So we think this is a good price at which both these stocks can be bought, particularly given both these companies after a long time would show some production growth. Particularly Oil India can show cumulative production growth of 15-20% over a 2-3 year period. Also ONGC can show about 10 to 12% production growth over a 2-year period. So both these factors, production growth coming back after a long time, plus a view crude will be around at $875 per barrel. And also government's policy seems to be suggesting government is in favor of these companies making good money so that we can reduce crude import bills, etc. So that sounds favorable for both these companies, and hence we have a positive view on both the names.
Two last questions. My first one is in terms of the oil marketing companies. Now, I read your recent report and you believe that the OMC's risk-reward ratio is currently unfavorable. But what about investors who are already invested? What's the outlook for them there?
So we have this cautious view on OMCs for some time now. Stocks have corrected as well. Now the valuation is still in a more reasonable zone. The key thing to watch out here would be currently they are making very high marketing margin, about 8-10 rupee per liter, versus historically they make about 3.5 rupee per liter. Our sense is once crude stabilizes, probably with the change in US president, once there's more clarity on the Trump administration policies and its potential implications on crude oil prices, then Indian government might decide on what to do given there's a scope for either cutting petrol diesel price by about 5 rupee per liter, or they can alternatively hike excise duty to boost its revenue to either reduce fiscal deficit or use that for other sources of expenditure. So our sense is this current higher marketing margin is not sustainable, and hence we would not be very excited about these names despite some corrections recently.
My last question to you, Mr. Mittal, is across the oil and gas space, what would be your top picks? Where do you see there's still value potential for the upside?
Yeah, so a top pick in the oil PSU space is ONGC and Oil India, given a positive view on crude price. And in the gas space, we like Gujarat Gas, but with a more like a 1 to 2 year view, given a view that spot LNG price should moderate sharply over the next 2-3 years because a lot of LNG supply capacity coming in. We also like GAIL, given the transmission business is doing relatively decent. There's a 5 to 6% volume growth. Trading business is also Also earning is quite strong. The only weakness there is a petchem business where margins have not been very great. So yeah, Gujarat Gas in gas space followed by GAIL would be our preferred pick.
Right. Okay. Thank you so much, Mr. Dayanand Mittal, for joining us and giving us those wonderful insights on the sector. And thank you, Mihika, for all those questions as well. With that, let's move on to